Hello, friends. When we do a business valuation or valuation of any other financial asset or financial instrument by applying discounted cash flow method under income approach, often we face a situation when we have to compute cost of equity. And in case we decide to compute cost of equity by applying capital asset pricing model, there we feel there is a need of computing beta factor. This video will be discussing how to compute that. If you apply capital assetting pricing model, if you know, capital assetting pricing model suggests that cost of equity is equal to risk-free rate of return plus beta into market return minus risk-free rate of return. If I put here the formula, it will look like this. KE, cost of equity, is equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So there is a need to compute beta factor here. And when we do business valuation, sometimes you do valuation of equity shares of listed securities, sometimes unlisted securities. So let us see how to compute beta for all these things. So let me share my PPT with you right now. Yes, friends. First, let us understand. I think screen is shared with you. Let us understand what is the meaning of beta. Then we'll see how to compute it by using some simple methods with the help of Excel sheets. So as you look at, you can see in the screen, beta is equal to covariance divided by variance. When I say covariance, what exactly I mean is that how the market is moving along with the stock. We are computing beta for a particular stock. So we'll be computing stocks return as well as the market return, how they move together. So that is covariance. So this is the measure of stocks return relative to that of market. Then what is variance? Variance, in fact, that represents how the market alone moves. So variance is the measure of how the market moves relative to its mean. So the numerator represents how the market as well as the stock move together. Denominator represents how market alone moves. Once we have understood this, it will be easier for us to apply the formula. Now I will be listing out some steps. Just have a look at these steps. To compute beta factor, beta, as you know, it measures the sensitivity of the stock with reference to the market. Beta represents systematic risk. All these things you are aware of. So how to compute? First of all, we need to compute the returns of the stock. Then also we need to compute the return of the market. You know, market index is the proxy of the market. So we can take the return of the market index, be it Nifty or BSE Sensex, that will be helping us to compute market return. So both stock return and market return has to be computed. After that, we will be computing beta factor. Look at the steps. Step 1, it suggests accumulate daily or monthly closing prices. With the help of these closing prices, we'll be computing the returns. And these closing prices has to be computed for a suitable period, maybe 1 year, maybe 10 years. It is up to you. For a particular period, please compute their closing prices. Similarly, compute either daily or monthly closing prices of market index. Market index is representing the market. So for the similar period, for the same period, also you compute or accumulate the daily or closing prices. Closing prices represents market sentiments. So let us catch those closing prices first. After that, once closing prices are known to us, by using that closing prices, we'll be computing returns, or we'll be computing how these prices are changing. That will show the price movements. So how we'll be computing? This formula explains that. So now you have to compute daily or monthly price changes. And this has to be computed separately for the stock and separately for the market. And the formula for this return is current price minus previous price divided by previous price. For example, let us say price of a stock today is 110 and tomorrow it was 100. So you can see there is a movement of 10. 10 is the return. 10 is the return on rupees 100. So here our price change will be 110 minus 100 divided by 100. So today, let us say 110. Yesterday, 100. So what is the movement? Movement is 110 minus 100 on 100. This is the percentage of the return. You can say 10% movement is there. Okay, this the moment is 10% is there. Yeah, you can compute. Okay, you can look at the black or look at the whiteboard. You can see how it is computed. Okay, now next, once we know these returns, then we'll be comparing how the stock is moving along with the index. So that formula, as I told you, will be computing covariance divided by variance. So exactly stock and index move together is computed with the help of this covariance, and how this index is moving alone is computed with the help of variance. So beta is the covariance divided by variance. In Excel, this formula will be useful. Covariance.p, when we are considering the entire data, is the data range is my entire population. I will say covariance.p, and entire stock range, returns of entire stock range and returns of entire index range will be selected, divided by variance of index range that will be selected. There is one more formula, which is the slope formula. We can use that formula also. Equal to, the formula is equal to slope, then select the sale range of the stock, comma, sale range of the index range. Now let me do it with the help of Excel sheet. Let me stop sharing this screen. For that thing, as you know, first let us compute the closing prices of a stock, then closing prices of an index. To do that, let me take you to a stock exchange. Let us visit to the website of Bombay Stock Exchange first. Just give me a second. I'm sharing screen now. I think you are able to see Google page now. I am going to the Mumbai Stock Exchange, www.bscindia.com, Bombay Stock Exchange we are visiting. So if you visit here, you can see this is their home page. We want historical data. So we can go down. Historical data is here. We are looking for historical data of a particular stock. Let me click here, equity. Now you can finding out, you see historical stock prices link is here. Let me click it here. Now I have to decide which equity for which we are going to compute beta. So if you know the equity code, then fine. You can type it here. Otherwise, you can type few letters, initial letters of a company. Suppose I'm typing here Ultra. Okay, Ultratech Cement is coming. Let us compute the beta factor of Ultratech. First of all, let us accumulate the closing prices. To measure beta, you can take daily closing prices or monthly closing prices. I am taking monthly closing prices. For a particular period, let me start it from April 2010. Let us say from April 2010 up to today. I can click here, submit. You see the data is available here. Opening, high, low, close. I'm interested in closing price. But since the data is voluminous, entire data is not shown here. I can download the file in CSV format, which I'm doing right now. Let us download it here. Yeah, this file is downloaded now, CSV format. Okay, let me see it in the folder. So this is the file. I am renaming it Ultratech. Okay, this is the Ultratech data. Now you see Ultratech data is available with me. Let me open it for you. Yeah, you see the entire data is available, month, open, high, close. Let me select the entire data and copy it another file where I am going to compute my beta. So I'll do one thing. Here I'm opening a new Excel file and giving the name as beta computation. Let me paste that data here. So you see data which is computed. Let me paste it here. These values are pasted here, but I am interested. Oh, sorry, once again, let me paste. Okay, data is pasted here. Now I wanted only closing price. So other columns, let me remove. This is the Ultratech data. All the columns are deleted. This is the closing price of Ultratech. You can see it's the closing price of stock. Let me put it in red color. Okay, please. Okay. Now let me stop share here. Now next step is that I'll be also computing the closing prices of the market. So again, let me take you to the Bombay Stock Exchange screen. Yeah, this is the screen. Now this time what we'll be doing. Now let me take you back here again. Let me show you from the beginning again. Here indices links are there. Okay, so if you go to the historical prices, historical information, okay, you can see here, or you can go to the home page again. You are interested to know the historical data. So historical data is here. Click it here. Now you are getting indices. Click here. Indices, historical price. Let us collect data. So many indices are there, you see. So we will be selecting Standard and Poor Basis Index, first one. Other sectorial indexes are also there for mid cap, large cap, you see, for auto, bank X. Sometimes we compute sectorial beta also. At that time, this indexes may be helpful. So select the index. I'm selecting this particular index. I'm interested to know the monthly closing prices, because for stock I have taken monthly closings. So from which period? Again from the same period. So we have done it for April 2010 onwards. Here also I'm doing April 2001 onwards. Submit. You are getting the data, but again, since data is voluminous, it can be downloaded in CSV files. I'm downloading here. Right? Now, if you open the file, open. This is okay. I'm opening the file. What I'll be doing right now, I will be CSV for the month. This file, let me open. I'm disclosing prices. I'm interested to know. Copy. I'm copying the closing prices. Okay. Let me stop sharing this file. Let me go to my file where I'm computing indices. You see closing prices of stock is here. Let me paste here. Once again, I have to copy. This is the closing price of the index. Closing price of stock is computed. Closing price of index is computed. So index is, let us change the color. Let us keep the index in purple color. Stock is in red color. Okay, is in blue. But next step is that we have to calculate returns or changes in price. Okay, how that is to be computed? For the stock, we will see stock return. Stock return is computed like this: current price minus closing price, current price minus previous price. So first entry we have to leave it. So stock return is, you see, this is the return of the stock. Current date minus previous date, then divided by, so whole divided by, so we have to take it in bracket. Whole divided by previous price. So this is the return of the stock. Here it is coming negative return. What? 972 has become 922. Same way we can compute return from the index or return of the market. So which is equal to bracket start current price, current closing price minus previous day closing price divided by previous day closing price. Okay. Once you know these are the returns or these are the changes, then I can drag it so that we can find out on daily basis what are the changes. Well, friends, now our basic data is ready. Returns of the stock, you can say market return. These are the monthly market returns, in fact. Average it out, find out what is the monthly average return. One can also analyze it to find out annual returns. Now we'll be computing beta. As you know, beta is the covariance divided by variance. So what I'm doing, you see, I'm applying a very simple formula. Just let me enlarge it. So first formula I'm applying equal to, let us say, covariance. Okay. You see, covariance P means I'm considering in this data as entire population. Covariance dot S means I'm considering this data as a sample. I am taking covariance P. Okay, covariance P, if you insert, then first select the stock return, range of sales that represent stock. Okay, then comma array2, range of return that represent the market. This is the covariance. Okay, covariance, right? Variance. Okay, so if you want, you can enter it here, then compute separately variances, or you can do together divided by variance. Here I'll be again taking variance dot P because it's entire population. Variance dot P of what? Of market. So if you calculate variance dot P of the market, okay, now bracket close. If it's press enter, computed beta factor. Beta is 9.6, it's less than 1, we call it low beta. So this stock is defensive stock, it's less sensitive to the market. Okay, there is one more way to compute also. What you can do, you can, once again, if you remember the formula which I had shown you, that what it was talking about, covariance by variance, you select the stock range, select the market range, and also you can do one more thing, slope formula also you can apply. Just a minute. So I'll be applying slope formula also. This is one more formula. Here what you do is equal to slope. Here also you can calculate. Okay, so you can take stock return, slope, bracket starts, then stock return, comma, market return. Here you see same factor is also coming. These two represents beta. Okay. right? There are other formulas also there. By using regression also you can calculate. If in your Excel data analysis is active, then you can do that thing also. So this is how we'll be able to compute. Okay, so formula I once again you look at the formula bar, covariance. Okay, covariance dot P, then the range that represents returns of the stock, comma, that range that represents stock return of the market, divided by variance dot P, that range represents the return of the market. And slope formula also you can see is equal to slope, bracket starts, then range that represents stock, then the range that represents market. This is how we'll be able to compute beta factor. I think you got a fair idea. Now you might be thinking in the mind that this was the listed stock, you could easily compute. In case, suppose you are doing a valuation where there is a requirement to compute cost of equity for a company which is not listed. So here actually the valuer has to apply his professional judgment, professional expertise. He may compute beta factor of that sector which is relevant to that stock. Suppose maybe IT sector, if it is an IT company, maybe pharmaceutical sector, pharmaceutical sectors beta, if it is a pharmaceutical company. Like this sector beta can be computed. That is one way. And that also needs to be adjusted because the equity that you are talking about is not marketable, not as marketable as a listed stock. So valuer has to make adjustment there. In case that is also not there, let us say there is no index which relates to that particular stock, then ideally then valuer has to think of, he can select some of the listed stocks, maybe 10 stocks of similar nature he can select and compute that beta, average it out, find out what is the normal sensitivity factor, a normal beta factor with reference to those stocks. Then apply his professional judgment and make some adjustments. By doing so, he will be able to compute the beta factor. So friends, I believe this particular video will be useful to you to the extent necessary. We have covered all these things. This will be helping you to compute beta factor. And thank you very much. Thanks a lot.